Something shifted this morning that millions of retirees haven't been told about yet. And if you're collecting Social Security right now, this directly affects the money hitting your bank account. The IRS and Social Security Administration just activated a new rule today, and the confusion spreading online is costing seniors real dollars. Not next month, not next year, today. This change reshapes how your benefits interact with your federal tax obligations. And depending on your income bracket, your monthly deposit could look different than what you've been counting on. Here's what nobody is breaking down clearly. Most news outlets are burying the details in legal language that takes a tax attorney to decode, but you deserve plain, straight answers about your own money. Whether you're already retired, about to file, or helping a loved one navigate their benefits, what went into effect today changes the calculation entirely. Stay right here, because in the next few minutes, you're going to understand exactly what changed, who it impacts most, and what steps you should take before your next payment date. So let's start from the very beginning, because to really understand what changed today, you need to know why this rule existed in the first place and how it quietly evolved into something that now affects tens of millions of Americans who are retired or approaching retirement. This isn't a story that started this week. It's been building for years, and the government has been making adjustments behind the scenes that most people simply never heard about, because frankly, it wasn't being covered the way it should have been. The relationship between the IRS and the Social Security Administration has always been complicated. These are two separate federal agencies, but they are deeply connected when it comes to your money. The IRS tracks your income. Social Security tracks your work history and benefit eligibility. But when those two systems start talking to each other about your finances, that's when things get interesting and sometimes frustrating for everyday retirees who just want to know how much money they're going to receive and how much of it they get to keep. Here's something that a lot of people don't fully realize. Your Social Security benefits can actually be taxed. That surprises a lot of seniors because they spent decades paying into the system, and they naturally assume that what comes back to them is completely theirs, free and clear. But that's not how it works. And understanding this piece is absolutely critical to understanding what today's change means for your wallet, depending on your total income. And that includes wages, pension income, withdrawals from retirement accounts, and even certain investment earnings. Up to 85% of your Social Security benefit can be subject to federal income tax. That rule has been on the books for years, but the thresholds that determine when you hit that taxable territory have not kept up with inflation. Until now, things are shifting. For decades, the income thresholds that determined how much of your Social Security was taxable were never adjusted for inflation. The numbers were set back in the 1980s and early 1990s, and they were essentially frozen in place. What that meant in real life was that more and more seniors every single year were getting pulled into a tax situation that was never originally intended to affect them. A retiree with a modest fixed income today looks very different on paper than a retiree with the same purchasing power back in 1983, simply because of inflation. So people who were not wealthy by any stretch of the imagination were getting taxed on their benefits as if they were, simply because the rules never evolved with the economy. This is one of the central things that today's rule touches on, and it has been the subject of serious debate in Washington for quite some time. Advocacy groups for seniors have been pushing hard for these thresholds to be revisited, and there has been significant pressure on both the IRS and Congress to make the system more fair for people who are living on fixed incomes and watching inflation eat away at their purchasing power every single month. So when you hear that a new rule is taking effect today, part of what's behind it is this long overdue acknowledgement that the system needed to catch up with reality. Now let's talk about what this actually means in practical terms for someone sitting at home watching this video right now. If you are currently receiving Social Security benefits, the first thing you need to understand is how your combined income is calculated, because that is the number that determines your tax exposure. The IRS uses something called your combined income, which is your adjusted gross income plus any non-taxable interest you earn, plus half of your Social Security benefits. If that total falls below a certain threshold, none of your benefits are taxed. If it falls in a middle range, up to 50% of your benefits may be taxable. And if it goes above the upper threshold, up to 85% of your benefits can be taxed. Those thresholds are what have been stagnant for so long, and any movement on them is a direct financial benefit to millions of retirees. Here's why this matters so much right now. Inflation over the past several years has been brutal for people on fixed incomes. The cost of groceries, housing, utilities, medications, all of it has gone up significantly. Social Security did provide cost of living adjustments, which are those annual increases you see in your benefit amount. But here's the cruel irony that not enough people talk about. When your benefit goes up because of a cost of living adjustment, your combined income goes up too. And if that pushes you over one of those stagnant tax thresholds, you could actually end up paying more in taxes on your increased benefit, effectively wiping out part of the raise you just received. That's been happening to retirees for years, and it has a name, and some people call it the tax torpedo or the Social Security tax trap, and it's a real phenomenon that real people have been experiencing quietly and painfully without fully understanding why their finances weren't improving, even as their benefit checks were technically going up. Today's rule change addresses this in ways that deserve a clear and careful explanation. The interaction between the IRS and the Social Security Administration is being formalized and updated in a way that creates new reporting protocols, new withholding guidance, and for many seniors, a direct adjustment to how their tax liability is calculated and communicated to them. This is not a small administrative tweak. This is a structural change to how two of the most powerful financial agencies in the federal government coordinate with each other when it comes to retirement income. One of the specific things that seniors need to be paying attention to right now is voluntary tax withholding from their Social Security payments. Many people don't realize that you can actually choose to have federal income taxes withheld directly from your Social Security benefit each month, similar to how taxes were withheld from your paycheck when you were working. You do this by filing a form called the W-4V with the Social Security Administration. The new rule being implemented today updates the guidance around this process, meaning that if you currently have a withholding arrangement in place, it may be recalculated. And if you don't have one and you've been paying taxes on your benefits through quarterly estimated payments or at the end of the year, now is a critical time to review whether your current strategy still makes sense, given the updated framework. Let's also talk about what this means for people who have not yet claimed Social Security, but are approaching that decision. The age at which you claim your benefits has enormous financial consequences, and the tax picture is a big part of that calculation. If you claim early at 62, your monthly benefit is permanently reduced. If you wait until your full retirement age, which for most people reading this is somewhere between 66 and 67 depending on your birth year, you receive your standard benefit. And if you delay all the way until age 70, your benefit grows by 8% per year beyond your full retirement age. That's a guaranteed return that is very hard to beat anywhere in the financial markets. But the tax implications of when you claim and how much you receive are now shifting under today's new rule. And that means people who are on the verge of making their claiming decision really need to factor this updated information into their thinking before they file. Another layer to this story involves people who are still working while receiving Social Security benefits. This is actually more common than many people assume. Plenty of seniors continue working either full-time or part-time after they start collecting benefits, whether out of financial necessity or simply because they enjoy working and want to stay active. The rules around earning income while collecting Social Security have always been complex, and the interaction with the IRS adds another dimension. If you're under your full retirement age and you earn above a certain limit, your Social Security benefit gets temporarily reduced. Once you hit full retirement age, that earnings limit disappears and you can earn as much as you want without any reduction to your benefit. But the income you earn still affects your combined income calculation and therefore your tax exposure. Today's rule change refines how these situations are handled in the system and creates clearer guidance for people who are navigating both a paycheck and a Social Security benefit at the same time. There's also something happening with how the Social Security Administration and the IRS are sharing data going forward, and this is something that should be on every senior's radar. Under the updated framework taking effect today, the coordination between these two agencies is becoming more streamlined and more automated. What that means for you is that the information these agencies have about your income and your benefits is being cross-referenced more efficiently than ever before. For most people, this is actually a good thing because it reduces errors and ensures that your benefit calculations are based on accurate, up-to-date information. But it also means that discrepancies, situations where what you reported and what the agencies have on file don't match, are going to get flagged more quickly. If you've had any unusual income situations, life changes, or discrepancies in your records over the past couple of years, now is a very good time to get ahead of that and make sure everything on file with both agencies is accurate and consistent. Medicare is also part of this conversation, and it's a piece that often gets overlooked when people are focused on Social Security taxes. Your Medicare Part B and Part D premiums are determined by your income through a system called IRMA, which stands for Income-Related Monthly Adjustment Amount. Essentially, if your income exceeds certain thresholds, you pay higher Medicare premiums. And because Medicare premiums are typically deducted directly from your Social Security payment, a change in how your income is calculated or reported can have a ripple effect that touches both your tax bill and your Medicare costs at the same time. Today's rule change, by adjusting how income thresholds interact with benefit calculations, could affect where some seniors land on the IRMA scale, potentially shifting their Medicare premium costs up or down depending on their specific situation. Let's take a moment and talk about the people this change is going to help the most, because that's ultimately what matters here. The seniors who are going to feel the most immediate positive impact from today's rule are those who are living on modest fixed incomes, people whose Social Security benefit represents the majority or all of their monthly income, people who don't have large investment portfolios or significant pension income on top of their benefits. These are the folks who have been getting pulled into taxable territory, not because they're wealthy, but simply because the old thresholds were outdated and the cost of living had dragged them over lines that were never meant to apply to them. If that description sounds like you or someone you love, today's change is directly relevant and potentially directly beneficial to your financial situation. At the same time, it's important to be realistic and acknowledge that this rule change, like any policy change, is not a perfect solution to every challenge that retirees face. The Social Security system as a whole is dealing with long-term funding pressures that go beyond what any single rule adjustment can fix. The trust funds that back Social Security benefits have been projected for years to face shortfalls in the coming decade, and Congress is going to have to make some decisions about how to address that. Today's change doesn't solve those structural issues, but it does represent a meaningful adjustment to how the existing rules work in practice. And for millions of current retirees, meaningful adjustments to existing rules translate directly into real dollars. One more thing that every senior watching this needs to understand going forward is the importance of staying informed and staying proactive. The rules around Social Security and taxes are not static. They evolve, they get updated. And the people who are best positioned financially in retirement are not the ones who set everything up once and then never looked at it again. They're the ones who check in regularly, who review their tax withholding each year, who understand how their income sources interact with each other, and who don't wait for a problem to find them. Getting a letter from the IRS is a much less pleasant way to find out that something in your financial picture has changed than watching a video like this one and taking action on your own terms. So if you take one thing away from everything covered here today, let it be this. The system that governs your Social Security benefits and your tax obligations is more dynamic than most people realize, and today's rule change is proof of that. The IRS and the Social Security Administration are updating the way they work together, the way they calculate your obligations, and the way they communicate those calculations to you. That's significant. That's real. And it deserves your full attention, not because it's something to panic about, but because it's something you can act on. Review your withholding. Check your combined income calculation. Understand where you fall relative to the tax thresholds. And if you have any doubt about how today's change affects your specific situation, reach out to a tax professional or a Social Security benefits counselor who can walk through your numbers with you directly. Your retirement income is something you worked your entire life to build. Protecting it, Understanding it and making the most of it is not just smart. It's something you absolutely deserve.